Good afternoon, everyone. We're just going to allow about 1 minute for more people to join us, and we'll get started very shortly. Good afternoon, everyone. Welcome to our second quarter market update. As you may all know, my name is Marianella Collado. I am the CEO and Senior Financial Advisor with Tobias Financial Advisors. Today, Matt, our Chief Investment Officer, will be walking us through second quarter market results, and we are excited to have a guest speaker, Alex Dryden from JP Morgan. So I'll give a more formal introduction, a little bit more background on Alex and what he does. So just as before we get started, please do note that what we will be offering today is general market information. The information provided today may not necessarily be specific to your personal circumstances, so it's always a good idea to speak with your advisor before implementing any of the information that we will be discussing today. So we look forward to speaking with you if you do have any questions. Who are we? As you may all know, we were founded in 1980 by Benjamin Tobias. We currently have over 325 million in assets under management. We like to say that cumulatively as a team, we have over 75 years experience in the financial advisory world, ranging from tax planning to investment management. So we're very proud of that. And as you may all know, education is very important to us. So it is important that all of our advisors are certified financial planners and have, among other designations as well. Today, we will have with us Alex Dryden, and to give you a little bit more information on him, we've invited him to provide us with a little bit more market insight from a different perspective. Alex is with JP Morgan. He's an associate with the Global Markets Insight Strategy team. He is a frequent guest speaker at CNBC, Bloomberg, and other major news outlets. He holds a degree in international business, finance, and economics from the University of Manchester. And he is also a chartered financial analyst, just like Matt is. So we're excited to have him join us and provide some insight as we walk you through our presentation today. So welcome, Alex. Okay. So, as you know, our overall investment philosophy is that no one can reliably forecast the direction of the market. So it is more important that as your financial advisor that we focus on the things we can control, which is number one, really listening to what your needs are and designing a portfolio that takes into account not only your risk tolerance, your time horizon, and basically the goals. So we like to say that our portfolios are goals-based, not taking any more risk than we need to, but making sure that at the end you're able to meet all your goals, and mainly for most of our clients is preparing for retirement. Structuring a retirement around key pillars of dimension, which are capturing value, and we can talk a little bit about that. And I know we always have the value versus growth discussion. So diversifying broadly. So we don't only want a balanced portfolio, but we want a globally balanced portfolio. Reducing expenses, trading when we need to, not any more, not any less, and of course also taking advantage tax opportunities if we don't necessarily need to rebalance. Um, so minimizing tax, as you all know, is one of our key focus here that we look at throughout the year. And so with that, I will pass this along to Matt, who will walk you through a very exciting agenda on second quarter markets.
Great, thanks, Nella. This is Matt Sainholtz, Chief Investment Officer here and Senior Financial Advisors here at Tobias Financial Advisors, and we are going to be covering kind of a tour of the world and the investment landscape, first focusing on what has happened in the previous quarter and the previous 12 months, and thinking about and reviewing what has occurred as far as volatility in the markets, and then we'll kind of look forward to what could happen in the future as far as what's going on with tariffs and different types of trade levies being tossed around in the global media. And we look forward to bringing Alex into the presentation here after I just cover a couple where have we been type of slides. So the the world stock market continues to at least be positive or near positive for the last 12 months. We've had some major headlines in the last 6 months. Starting back in January 2018, we had December's Trump signing into the sweeping tax laws that are now going into effect for the most part in 2018. We've seen 2 interest rates increases by the U.S. Fed this year, and we've also also seen a lot of geopolitical news and the fact that Trump has pulled out of U.S.
So I'll just, if I can interrupt, I think you should all be muted, but make sure that if your microphone has actually, you've opened the ability to speak, that you mute yourself, because we do hear some music in the background. So just be sure to do that. I don't know if you're all hearing that.
Thank you. So we've seen tremendous headlines this year. We've pulling out of different nuclear arms deals and the like. So we've seen the market digest this information, and what we've seen so far, at least in the previous quarter, second quarter, the U.S. market's acting positively as defined by the Russell 3000, which encompasses U.S. large companies and small companies. For the previous quarter, second quarter up almost 4%. Vice versa on the international and emerging markets indices, basically flat, little low on the international developed countries. This is Europe, developed Europe, Japan, these types of countries. Emerging markets were down 8% in the second quarter, while global real estate was up 6% in the second quarter, where that is pretty much getting back most of the losses that sector experienced in the first quarter. Bond markets were down slightly in the second quarter, and I will move on to the next slide and kind of just show this colorful chart here, where we have the orange box around the year to date. Let me just explain the chart for a moment. Each color represents a different asset class. So orange is very bright on this chart. So we'll look at that as being small caps in the U.S., small companies traded in the U.S. markets. And so far, year to date, that returned 7.7%, clearly the highest leader through the first 6 months of the year. Whereas scrolling down on the year-to-date column, emerging markets, as we just saw on the previous slide, were down for the year-to-date 6%. An asset allocation, or a broadly diversified portfolio, puts you about, which is represented by the line growing across left to right, going back to 2003 all the way to 2017, and then year-to-date. For year-to-date, we've had basically a flat year in the global markets when you're looking at a diversified portfolio as defined by J.P. Morgan. One of the things here that we always like to point out is the volatility is back. We're seeing some big moves, mostly more in January and February, where we saw larger scale moves in the U.S. equity markets. This chart represents, I like this chart, I'd like to spend a minute or two on it. The red number going across the bottom represents the biggest drawdown in each of the years dating back to 1980 all the way through to the present. So these are the largest drawdowns in red, and then the gray bar represents where the S&P 500 actually ended the year. So year to date, for the first 6 months, we've seen a negative 10% drawdown, and that represents a correction in the stock markets. A correction is defined as any drawdown more than 10%. We're not quite, we're not at a bear market. A bear market would be defined as 20% downturn. And so what this chart shows on average, though, even though on average, an average drop for the year is a negative 14% drop per year, 29 of those 38 years have resulted in a positive return, even though you might have experienced a 14% drop. I guess the basis of this is that, markets are volatile. We're going to see ups and downs, but that doesn't mean if we're down for a couple quarters that it may not return and kind of recover and still be a positive year. So year to date, the S&P 500 is up 2%, and that's where we kind of stand in the U.S. markets as of June 30th. So I'd like to kind of explain, where we are with this chart here, and this is price to earnings ratio chart, and these two charts, one on the left is based upon 1 year, and the one on the right is 5 years. So let me just explain this real quick, and I'll ask Alex to help me kind of explain this as well. So what we're looking at here is price to earnings, which is a measure of the kind of the expensive nature of where the market is today. And currently a forward price to earnings ratio is 16.1, and does that indicate what's going to happen in the future, and what kind of, is the market overvalued or undervalued? And Alex, welcome to the call. I'd like to get your kind of thoughts about where we are as far as valuation in the stock market. Is the stock market overvalued? Is it undervalued? If you could kind of talk through.
Put it in perspective.
Yeah, please.
Yeah. Great. Thank you very much, Matt, and thank you very much for giving me the opportunity to talk on this call. This chart's a really good chart for a couple of different reasons. Firstly, it's a good measure of investing in, knowing how to invest over a 1 year or a 5 year time horizon, and the valuation being a very important starting spot. So let me just start on the left-hand chart for a second. Right now, we've got a price to earnings ratio of 16.1. Now, historically, that is bang in line with its 25-year average. Right now, according to this measure, the S&P 500 is not particularly expensive, nor is it particularly cheap either. Therefore, this is a reasonable time to be buying. It's not super attractive, but it's not super expensive either. Starting on that left-hand side chart, though, what you can see is that when using the price to earnings ratio for a 1 year time horizon of returns, valuations just aren't the best measure of that. On a 1 year time horizon, things get pushed around, politics can get in the way, some particularly negative economic data could knock us off course, and valuations just don't really give us much of a good leading indicator of about a 1 year time horizon. However, for any investor who's actually investing for the long term, 1 year returns, frankly, don't always matter that much. It's about keeping your eye on the longer term time horizon. And this is where the chart on the right-hand side starts to show its power, because a price to earnings ratio of 16.1 implies an annualized return over the next 5 years, hovering around the high single digit mark, about 8 to 9% over the next 5 years. That's actually a pretty good return on a longer run basis. And to make matters even better, if we went back a few months and went back to the third and fourth quarter of last year, the price to earnings ratio actually got up to as high as about 18 times earnings. The implied forward return from that point was actually not particularly attractive, falling to the low single digits. So actually the stock market and some of the volatility we've been seeing year to date has actually flushed out some opportunities for long-term investors who are willing to see through the short-term noise and focus on the longer-term objectives. I'll pass it back to Matt to just if there's any other comments you'd like to make.
No, that's a perfect explanation of kind of where we are as far as valuation, and this is kind of why we like to look at this chart and say, all right, well, this may be an opportune time, which kind of leads us to our next slide. We get a lot of clients who are just concerned in general about the longevity of the bull market, where we've come from the depths of 2008. It's coming up in October would be kind of the 10-year anniversary of some of the major investment banks going down, and what we've seen since then, and the recovery since. Is it a good time to still think about investing and where we are in the cycle? So that valuation slide is very helpful to kind of examine and get a sense of where we are from a valuation standpoint. So as I mentioned here, this is kind of a graphical look of the expansions and recessions over the different periods, all the way going back to 1900. And I'll toss this question over to you, Alex. Where if you could kind of walk us through the chart and kind of explain, what this expansion over the last 10 years, how it ranks relative to historical.
Yeah, Matt, you're bang on right. This is probably one of the biggest questions we're getting from clients at the moment about when is this cycle going to end? It's been going on for 10 years. We must be close to the end by now. It's one of the longest on record. And this chart really puts this in perspective. Let's start on the left-hand side. What we're looking at here is the length of economic expansions in gray and the length of economic recessions in the United States in blue, going back to the 1900s. Notice that the current economic cycle that we're on is the second longest economic expansion in US history at 108 months as of the end of June. Now that we're into July, it's 109 months. If we keep growing for another 12 months, this economic expansion will be the longest economic expansion in US economic history, beating the expansion of the 1990s. So we've only got about 12 to 18 months in order to overtake that. So this economic expansion has certainly been very strong, but it's also quite unique for how weak it has been. If you look at the right-hand side chart, what we're looking at here is prior economic expansions and how they have developed over time. So what we're seeing is how quickly growth got up and going. Now note that a lot of the economic expansions, once we start to see a recovery and growth returns, economic growth gets up and going really quickly, sort of like an 100-meter sprinter getting out of the blocks, up and running really fast. However, as you can see on the right-hand side chart, there is a lonely light blue line at the bottom. That is the current economic expansion. It differs from its peers because it has been so much weaker than prior economic expansions. Growth has been a lot slower. Things have took a lot longer to get going again. Why was that the case? We believe it's because many of the previous economic expansions were simply caused by a normal benign economic recession. This economic expansion began with a financial crisis. That damaged animal spirits. It hurt the economy, businesses, and consumers a lot more, and therefore it took a lot longer to get up and going again. Now, whilst this economic expansion has been weak, one of the benefits of its weakness is that it is likely to rumble for a lot longer, sort of like a slow burning fire. It's not been explosive. It's not suddenly burnt brilliantly and brightly. It's smoldering along quite nicely. Therefore, we think it can go for a little bit longer. That's why when we thought about the chart before with the valuations and the price to earnings ratio that we're at now, we think the economy and equity markets suggest that we can still be finding opportunities in US equity markets, considering this economic backdrop continues to be pretty strong.
That's excellent, because that's the question is we come with, clients who've just had a windfall and they're sitting with significant assets, just cash, and that big question of, well, is now a good time? Do I wait? And the message is always the same. No one's going to get that timing right, but you just got to get in and be disciplined along the way.
Right. Great. Well, now that we've kind of talked about the U.S. economy and our markets and where we are currently, want to look at global. We're big believers in global equity markets, and the pie chart on the right-hand side, top right-hand side of this chart, kind of shows how of all the U.S. All the country world equity capitalization, where different stock markets represent. The United States represents 54% of the world equity market capitalization, where emerging markets are at 12, and so on and so forth. So a little less than half of what you could invest in as far as equities are concerned are located across the globe. So just to recap of what's been happening year to date, as we covered earlier, the S&P 500 is up 2.6%, whereas it's been negative in other areas, particularly emerging markets getting hit hardest at negative 6.5%. And if we're looking at different countries, Brazil at negative 17% as far as returns year to date, and France kind of basically flat. So we've seen a lot of variation here in the returns, and we are thinking about, okay, we see it every day in the headlines. What's going to happen? Excuse me, I think there might be someone that still may not be on mute at the moment. If you can mute your microphone or your phone, it would be helpful. Thank you. So as I was saying, so we're a global economy. We're feeling that, every trading partners all over the globe now, every time we turn on the TV, it's something along the lines of a new tariff or a trade war, which sounds really scary. And, was kind of seeing maybe that some of the returns are being affected by these trade wars. So, Alex, it's such a broad question, but how do you kind of come up with the fact that tariffs are being levied against China, against Europe, and NAFTA pulling out of NATO? All these different headlines are happening. How does an investor stand to stomach that information, how to process that information, and how to think about it as far as long-term investing?
So that is certainly a very broad question, but it is front of mind for many investors in the United States and globally right now. I think when it comes to the trade discussion, I think it's important to keep this thing in perspective. The trade tariffs that have been increased, whilst making a lot of media noise and headlines, don't actually amount to a huge amount of GDP. By even the most extreme measures, it is barely 2% of US GDP that has been leveraged in trade tariffs. So it's not the be all and end all, despite what you might read in the newspapers and see on the TVs. And in fact, I actually have taken some confidence. This trade tariff discussion has really been rumbling on since March, February time of this year. Yet when you look at the economic data and you look at things like consumer confidence, business intentions and business confidence, it is not really showing up in the economic numbers at the moment, which for me suggests that a lot of this is noise and isn't actually impacting on the economic fundamentals. And it's the economic fundamentals which at the end of the day drive investors' decision-making and drive long-term results. I would encourage investors with a long-term time horizon to stick to the course. International equities still look an attractive place on a valuation front. They're still seeing some earnings growth coming through as well, which is making it look attractive there. And the global economic backdrop doesn't seem to have been too much damaged by the trade and tariff discussions. So with that in mind, I think for us, we're still seeing a lot of opportunities in the international space right now, and encourage investors, despite the weak start to the year, to stick to the course, focus on the longer term objectives, and not be buffeted around by the trade discussions that I think are being hyped up by the media.
Yeah, thanks, Alex. That's one of the messages that we're sending to our clients as these are occurring. You see one headline about a different trade tariff, and then a week later that tariff has either been reduced in size or maybe there's a new deal in place. So it's very hard to react in these markets to the headlines, and that's just one of our tenets of our investing philosophy is trying not to react to the headlines. So thank you for that. We're going to move forward to kind of the fixed income, which is kind of the bonds and different areas of the markets in that regard. So what we've seen from the U.S. Fed is 2 rate increases, though so far this year, the last one coming last month in June. Indications, depending on which economists you might be looking at, there could be 1 or possibly 2 more rate hikes this year. The 10-year Treasury that has been issued by the U.S. government has started the year at a rate of 2.4%. We've seen it cross over as high over 3% so far this year, and as at the end of June, it was at 2.85%. So we're starting to see interest rates increase, which is, it could affect our economy, our borrowing costs, purchasing homes, real estate, and so. As a reminder, the valuations of bonds are inversely or negatively affected by rising rates. When rates rise, the value of your bonds or bond funds do decrease. So, it's very important to kind of take a look at the bond market and make sure that we're understanding what's happening with the rising rates. This chart on the right kind of outlines what an increase of a 1% increase rate in interest rates could mean for the valuation or return on a bond. And what this chart basically shows is the longer you go out, 2-year, 5-year, 10-year, 30-year, 1% increase in interest rates have a greater impact on, say, a 30-year bond than a 2-year bond. And so this is just kind of outlining potential returns based upon interest rate increases. Here at Tobias Financial Advisors, we typically have been shifting towards the front end or the lower time frames for the bonds to combat these rising rates. And Alex, there's a lot of discussion about tax cuts, and this is going to be more of a global economic or a U.S. economic question. We're seeing interest rates increase with tax reforms decreasing, and perhaps even some more government spending bills. So, a longer term question, and what I'm kind of going at here is the health of the United States economy. Is there room for 2 more rate increases this year, and what are your thoughts around that?
It's a good question, Matt, and it's certainly something that the markets are thinking about at the moment. For me, when I'm looking at the Federal Reserve and their future projections, I think when we're seeing growth, particularly when it's been stimulated by by the fiscal package and the tax reform bill, which has really kicked in and helped second quarter GDP numbers. We think second quarter GDP could be as high as 4% for this quarter, which is pretty impressive considering we've been growing closer to 2-3% for much of the last few years. Now, with that as the backdrop, I think that gives the green light for the Federal Reserve to continue raising interest rates. They have already raised rates twice this year. They've done 7 interest rate hikes since they began in December of 2015. We believe that they should go another 2 times in 2018. The market is broadly on board with that idea. I don't think any rate hikes would upset or disturb the market, considering they've got that priced in. Looking into 2019, however, there's a few more questions to be asked. Will the US economy continue to grow at its current rate? Will we start to see the fiscal effects begin to fade? That is difficult to say at this juncture. But as we move through this year, we might get a better idea. With the data that we have to get at the moment, and when we're looking ahead into next year, we think that maybe 2 to 3 interest rate hikes from the Federal Reserve in 2019 seems appropriate, but we will be looking to the Fed to give us a little bit more guidance later on this year about what they are thinking around interest rate hikes for the next calendar year. So to recap, 2 more rate hikes this year. We're looking for 2 to 3 next year, but a couple of question marks on those 2019 rate hikes.
Very good. Thanks, Alex. This next chart is just kind of diving into the different sectors in the fixed income world. Again, going left to right, it kind of gives historical annual returns for different types of fixed income and fixed income sectors. And year to date, again, with the interest rate increases, the orange one, which is representative of the U.S. kind of government bond index and some kind of a Barclays aggregate, which is kind of inclusive of a lot of different sectors in the United States, is actually down 1.6% year to date as of June 30th, mostly due to the rate increases. So even with a combination of all these different asset classes, the asset allocation sector in the bond world is down 1.7%. And so, Alex, if we're forecasting higher interest rates and right now it's not a great performing asset class, why do I need bonds anyway?
That is a good question. It's been a question that we've started to get after a 30 to 40-year bull run in the fixed income markets, where investors have got very used to getting nice returns from their fixed income holdings. They are now asking the question in this rising interest rate environment, why bother with bonds in the first place? For me, the very key aspect here is the diversification benefits that bonds bring. Now, the way that I would see it is that bonds are sort of the insurance that you take out on your home. You don't get home insurance thinking that your house is about to fall down. You get it just in case it does. Now, that's why you have bonds in the portfolio. If equity markets start to decline and we start to see the economy begin to roll over, you're going to be really grateful that we had some insurance in the portfolio in the form of some bond protection. For the last few years, you've been paid to take out that insurance. Unfortunately, in this rising interest rate environment, we're going to have to give up a little bit of that return in order to have that protection baked into the portfolio. I think the other key thing to be mentioning here is that in this period of rising interest rates, it is important to be active when managing those fixed income portfolios and having someone providing a bit of guidance during this rather turbulent period fixed income markets around which sectors we want to be in, which areas we don't. And I think that has become more important than ever over the course of the first 6 months of this year in terms of picking sectors and being active.
Thank you. That's a great response, and that's how we look at our fixed income and our portfolios as well, where it's it's that part of the portfolio when the stock markets aren't acting the way we'd like, gives us a little bit of comfort for stability. So this has been great. We're going to just kind of cover some general themes that we've already recapped a little bit here today, and we'll open it up for some more questions for Alex. So, what we're seeing, what we kind of covered here is that the market fundamentals, the price to earnings ratios still seem to be in a positive way with the combination of economic data, unemployment being low, consumers having a bit more money, and corporations having a bit more money from lower tax rates. These all could continue this long bull market into the future. Some of the things that may, if you're a pessimist or if you're just thinking of what could kind of crack some of this bull market would be, these trade tariffs and, global growth slowing down. So what's something that we're going to be keeping an eye on, of course, as we monitor our portfolios that we manage and going forward. So let's ask Alex a couple more questions, and if you feel free, there is a questions bar on our webinar technology here. So if you're interested in submitting a question to Alex, please do so, and we will do our best to cover them all. One that we kind of haven't touched on too far, and what I like to talk about sometimes is our emerging markets and how that typically compared to the more developed countries, that's where some of your growth comes from in the portfolio, albeit more volatility. We've seen some emerging markets being on the bottom end of the spectrum as far as year-to-date returns in those countries. So, Alex, could you kind of walk us through maybe a little bit on maybe why that's occurring and what might be in store to turn that around?
That is a very good question, because emerging markets has had a fantastic 2017. And then in the first half of 2018, we've seen it struggling a bit. Why is that the case? For us, it is focusing in on the US dollar. Typically, a strengthening US dollar, which is what we've been seeing so far this year, puts pressure on the emerging market economies by boosting their debt repayments and putting pressure by sucking money out of their economies, causing misbalance and some potential strain, which we've seen show up in the emerging market equity performance. Now, going forward, do we think that this strengthening dollar will continue? We think the dollar maybe has a few more months of strengthening in it before finally peaking and beginning a downwards decline, which could last for a number of years. So whilst we think emerging markets is going through some short-term pain, when we look out over the longer term, which is how we really should be addressing emerging markets, we see long-term opportunity. We see an emerging middle class in places like China and India with potential spending power that could help boost their equity markets and return investors who have a longer-term time horizon and see the opportunities now. For us, emerging markets, particularly in that Southeast Asia Pacific region, is an area of opportunity despite the short-term pain they've been suffering in the face of a stronger dollar over the course of this year.
Mm-hmm. Now, you brought up China there, and one of our one of the largest economies in the world at this point, and a big trading partner, and one that you could argue, some may argue, that it's not the most fairly imbalanced trading partner that we have out there. So, are tariffs the only way to kind of combat or kind of equalize trading, if that's something that the U.S. government wanted to do? Are there other things that that may be in place? What else could affect the balance between U.S. and China trade?
Well, there's a number of things that are on the table here that I think are being negotiated. I think taking a big step back and just stepping away from the trade discussion for a second, what we're looking at here is a relationship between the dominant world superpower in the form of the United States and the emerging superpower in the form of the Chinese. Now, that relationship goes back and forth, and there are times when it becomes a little bit strained and sometimes when it gets a little bit better. Right now, what we're trying to work out is the state of play between these two nations. Now, that involves talking about the trade discussions. It also involves talking about geopolitical events such as North Korea, as well as things like the Chinese holdings of US treasuries, for example, which is quite significant. All of that is up for debate. And I think what we're seeing at the moment is the frictions going back and forth with a new administration coming in, as well as some changes politically in China in the form of President Xi taking over as essentially president for life over the Chinese economy and political setup. Now, in terms of what we can do to tackle the trade misbalances between the US and China, tariffs has been the way that we've gone about it for the first few months of this year. But what we're starting to see is a little bit more negotiation going on. The US are trying to get the Chinese to open up their economy. So rather than slapping tariffs on and trying to limit the number of imports coming out of China and into the US, the way to correct this balance is to try and increase the flow of goods moving from the US into China. Well, what does the US have to offer? They are leading lights in areas like financial services, aerospace and defense, high-level technology contracts, and that is an area that the Chinese are increasingly interested in. Rather than just taxing and hitting imports from China, we can look to try and boost US exports. That's the other way to correct this trade imbalance. That's where a lot of the administration are also starting to show some signs of progress, getting the Chinese to open up their economy and allow more US businesses flexibility within the Chinese borders. That's another way of increasing this rather than just going down the tariff route.
Great. Great. I think we have, looks like time for maybe one more question.
So a question, Alex, that's come up in a couple of our client meetings, and it's with respect to South America, specifically Brazil, and opportunities within those emerging markets. Do you have any thoughts on that? I know you talked about opportunities in Southeast Asia, but what are your thoughts in South America and specifically Brazil?
It's a good question. For the moment, we're a little bit more cautious on the Latin America region. The reason being is that we have, especially in Brazil's case, political elections coming up later this year, where there are results, where calling those results is really quite difficult to do, and a number of the potential candidates are not the most, shall we say, market-friendly opportunity for Brazilian politics. With those political clouds hovering over the Latin American region, we're just a little bit more cautious. There are some areas of opportunity, and the valuations do look quite attractive for those investors who are willing to stomach that volatility. But for the time being, from a sort of broader opportunity set, we see more upside in the Southeast Asia Pacific region than we do in the Latin American region. Maybe it is a case of ask me that question at the end of this year, once some of those elections are out of the way and we get a bit more clarity, then we might see some upside going into 2019. But for the time being, we're in a holding pattern, waiting for those elections to get out of the way.
Excellent.
Great. Well, this has been excellent. Alex, we really appreciate you spending some time with us this afternoon to share your thoughts and thoughts from JP Morgan's deep investment research capabilities team. And so we would like to thank you and Nella, and to our audience and listeners, please contact us directly if you have any questions regarding your own unique portfolio and how we're structuring our Tobias Financial Advisors portfolios. And we look forward to seeing you soon or having you attending a future Tobias Financial Advisors event. Thank you.
Thank you.